If you're collecting CPP and OAS this year, or you're about to start, you need to understand how CPP and OAS work in 2026. We're talking about benefit increases, updated clawback thresholds, and contribution changes that are already affecting how much income you're receiving or paying in. Some of these changes will help you, but others could catch you off guard if you're not prepared. So today, I'm going to break down what's actually happening with CPP and OAS in 2026, what it means for your retirement income, and what you need to do to stay ahead of this. Hi, I'm Ivan Dory, owner of Solid State Wealth. If you would like to see what these changes mean for your specific retirement plan, book a time with me. The link is in this description below. So part 1, the CPP enhancement. What's happening this year? Let's start with CPP because this is where we're seeing the most significant long-term changes. The Canada Pension Plan has been going through a multi-year enhancement since 2019, and we're now in the phase where both contributions and future benefits continue to build. So if you're still working, you're paying more into CPP this year. If you're already receiving CPP, your benefit is indexed to inflation annually. So here's what's happening in 2026 for workers. The year's maximum pensionable earnings, that's the YMPE, is now $74,600, up from $71,300 last year, which is a 4.6% increase. This means if you earn $74,600 or more, you'll contribute the maximum to CPP. The contribution rate is 5.95% for employees and employers each, unchanged from 2025. So if you're self-employed, you're going to pay on both sides. So that's about almost 12% of your pensionable earnings. But here's what matters in 2026. The second earnings ceiling continues as part of the enhancement framework called the year's additional maximum pensionable earnings, or YAMPE, which is set at about $85,000. It is. If you earn between $74,600 and $85,000, you'll contribute an additional 4% on that portion, or 8% if you're self-employed. If you earn $85,000 or more, your total CPP, your employee CPP contributions, including the additional CPP above the YMPE, can be about $4,600 for the year. That's up from about $4,400 in 2025. Now the trade-off. Higher contributions may affect your future benefits. So the CPP enhancement is designed to increase the income replacement level over time, moving from the old 25% design toward about 1/3 of earnings for people who contribute under the enhanced system for many years. If you're in your 40s or 50s and you're still working, these contributions may increase your eventual benefit when you retire, which is a good thing. If you're already retired, these contribution changes don't affect you, and your CPP benefits stay the same. Part 2, CPP benefit increases for 2026. So CPP payments are indexed each January based on inflation. So for 2026, the maximum CPP benefit at 65 is about $1,507 per month. And if you're already receiving CPP, your payment was automatically adjusted in January. You don't need to do anything. That maximum is higher than last year, so most people saw a bump automatically in January. But here's what many don't actually realize. The amount you receive depends on how much you contributed and how long you contributed for. The maximum is just that, a maximum. Most Canadians don't get the maximum. Your amount depends on your contribution history and the amount of years that you worked and contributed to that plan. If you're not sure what your CPP entitlement is, log into your My Service Canada account and check your statement of contributions. It will show your estimated benefit based on your current record. So part 3, OAS updates and the clawback threshold. So now let's talk about old age security, because this is where things get a little bit more complicated and where many retirees, especially couples, can get caught off guard. OAS is adjusted periodically, not just once per year. The maximum payment depends on your age and the current rate period. So the key point is benefits generally rise with indexing, and the 75 plus group receives a higher maximum due to the permanent increase introduced in 2022. That's good news. Here's the part you need to watch carefully, especially if you're married. OAS is subject to a clawback. if your individual net income exceeds a certain threshold. So that's a main point. This is your income, not the household income. Each spouse is assessed individually. So OAS clawback is based on your individual net income, and the threshold is indexed every year. Here's a quick example. The recovery threshold was 93,400 or so, very, very close for 2025 tax year, and the 2026 threshold will be higher due to indexing, so you want to check the current number before making a large withdrawal. Here's how the clawback works. For every dollar of income you earn above that threshold, you lose 15%. Once your income reaches the mid 150s or higher, depending on your age and the year, your OAS can be fully clawed back. You don't get it anymore. One thing to remember too, the clawback is calculated off of your tax return income and applied to your future OAS payments based on your prior tax year. This is critical if you're managing your RRIF withdrawals, your investment income, or other capital gains from different assets. A poorly timed withdrawal strategy could push you over that threshold and cost you many thousands of dollars in lost OAS benefits. An important clarification for married couples: OAS clawback is calculated on each person's income, as we mentioned, not combined household income. So if you and your spouse each earn 90,000, you're both safe. But if one spouse earns 100 and the other earns 40, the higher earning spouse will lose some OAS, even though your combined income is 140, which is less than the other example of the two people both earning 90. So this is why income splitting can be very powerful for couples in retirement. If you're 65 years or older, you can split up to 50% of your RRIF income with your spouse. This can help both of you stay in lower tax brackets and avoid OAS clawbacks. Part 4, what these changes mean for your income. This is a BC example, British Columbia. So let's bring this together with a real world example using BC tax rates. Let's say you are 68 years old, retired in BC, receiving both CPP and OAS. You're getting $1,100 per month from CPP and roughly $740 a month from OAS in 2026. It's about $1,840 per month or $22,000 a year from government benefits. Now, let's say you're also drawing $40,000 a year from your RRIF. Your total taxable income is now around $62,000. After federal and provincial tax, your take home would generally land in the mid to low $50,000, depending on your deductions and credits. Well below OAS clawback threshold, so you keep your full benefit, which is great. What happens though if you decide to take an extra $35,000 from your RRIF because it's an RSP turned into a RRIF, it's not locked in. You do this 1 year because you're buying a car, husband wants a new truck, renovating your house. It happens, right? Your income now jumps to $97,000. Suddenly you could be over the clawback line. You could lose some of that OAS that year, and that extra income pushes you into a higher tax bracket ballpark. That can mean more tax, depending on your deductions and credits. So the direction of the math is what matters here. So here's where married couples really need to pay attention to. If you're married and your spouse has a lower income, consider taking that $35,000 from their RRIF instead, or splitting the withdrawal between both of you. This keeps both of you below that clawback threshold and minimizes your overall tax bill. So for instance, if you take $17,500 each from your respective RRIFs, you're both still well below the threshold. No clawback, lower taxes, same amount of money taken from the RRIF. This is why timing matters. This is why you need a withdrawal strategy. This is why small decisions can have a big tax consequence in retirement, especially for couples. Part 5, CPP timing. When should you start taking it? One of the most common questions I get is, should I take CPP early at 60, wait until the default 65, or delay until 70? The answer depends on your health, your income needs, and your overall retirement plan. But here's what you need to know about the numbers. If you start CPP at age 60, your benefit is reduced by 36% for life. So if your full benefit at 65 would be $1,200, starting at 60 means you'll receive about $768 per month instead. If you delay CPP until age 70, your benefit increases by 42%. So that same $1,200 at 65 now becomes $1,700. So which one's better? If you need the income at 60, or if your health isn't great, taking it early might make sense. But if you have other income sources like a pension, RRSP withdrawals, or part-time work, and you can afford to wait, delaying CPP can give you significantly more income in your 70s and 80s when you might need it the most. So here's a quick rule of thumb. For many people who expect to live well into their mid-80s or beyond, delaying CPP often pays off. If you have health concerns or family history of shorter lifespans, taking it early might be the better move. For married couples, this gets even more strategic. You don't have to start at the same time. You both are individual people. One can start early, one can delay. So a common strategy is for the lower income earner to take CPP early, say at 60 or 62, while the higher income spouse, the earner, delays until 70. This gives you some income now while maximizing benefits later. And if you're a couple, timing can affect these survivor outcomes. It's not as simple as just saying the survivor keeps the higher CPP. CPP survivor benefits follow their own formula, caps, coordination rules. So the right move is to model your options together. Don't just guess based on your age. You should run numbers based on your situation. If you're married, run them together. Part 6. Strategic moves to make now. So what should you be doing right now to make the most of these 2026 changes? Move number 1, check your CPP statement of contributions. Log into your My Service Canada account, review your CPP record. Make sure all your contributions are recorded correctly. If there's gaps or errors, get them fixed now before you apply for benefits. Move number 2, estimate your retirement income. Add up your expected CPP, OAS, your RRIF withdrawals, and any other income sources that are taxable. See where you land relative to the OAS clawback threshold, which does increase each year and is indexed. So if you're anywhere near that threshold, a large RRIF withdrawal or capital gain from the sale of an asset can create an unexpected clawback when your income is higher. If you're close, think about how you can manage your withdrawals to stay under that line and keep those government benefits. For couples, do this calculation for each spouse individually. Don't just look at household income this time. Remember, OAS clawback is individual. Also note, OAS can't be split between spouses. CPP is different. There is a CPP pension sharing option for couples to want to reduce taxes, but it has specific rules and you have to apply through Service Canada. But you can split RRIF and pension income once you're 65 or older through your tax return. OAS, you can't. Move number 3, consider income splitting. If you're 65 or older and married, you can split up to 50% of your RRIF income with your spouse. Now, you both must be 65 or older for RRIF withdrawals to be eligible for income splitting. This is, though, one of the most effective strategies for reducing household taxes and avoiding OAS clawbacks in retirement. A quick clarification, pension income splitting is a CRA tax return election. It's different from CPP pension sharing through Service Canada. So for example, if one spouse has 80 grand in RRIF income and the other has none, you can allocate up to $40,000 to the lower income spouse. This can save you thousands in taxes every year, of course. Another important note to remind yourself to be aware of, this is a notional split that happens on your tax return only. No physical money is actually transferred. The income is still paid to the RRIF owner, but you report it differently on your tax returns using the form, the T1032. So move number 4, plan your CPP start date. Don't just simply take CPP at 65 because it's the default. Run scenarios for 60, 65, and 70. Factor in your health, your savings, your other sources of income. If you're married, consider staggering your start dates. The right timing can add tens of thousands of dollars to your lifetime income, and for married couples, it can maximize the survivor benefit. Move number 5, review your withdrawals annually. Tax brackets change, clawback thresholds change, your income needs might change. Review your strategy every year to make sure that you are optimizing your portfolio, your plan for taxes, for clawbacks, for long-term sustainability. If you're married, review this together. What makes sense for one spouse might not make sense for the other, or your buddy down the street, or friends. Everybody's different. But coordinating your withdrawals can save you both a lot of money. Part 7. What this all means for you. The CPP and OAS updates for 2026 are actually mostly good news, for once. Benefits are going up with inflation, CPP enhancement is providing more future income for those still working, and the system is adjusting to protect purchasing power to try and recover from this large inflation era we just went through. But here's the reality. Government benefits alone are not going to be enough for almost every Canadian, I think, to retire comfortably. CPP and OAS might give you $2,000 to $2,500 a month, and that's if you're getting close to the maximum. That's why your RRSP, TFSA, and other personal savings matter so much, and the timing of when you take those. That's why having a plan for how you draw from those accounts when you start CPP and OAS can make a difference of $50,000, $100,000, or more over the course of your retirement, depending on your situation. For married couples, the stakes are even higher. The decisions you make together about RRIF withdrawals, income splitting, CPP timing can impact both of you, not just now, but for the rest of your life. And after one spouse passes away, those decisions will determine how secure that surviving spouse is financially. The 2026 updates are just one piece of the puzzle. The real question is, and should be, how do all of these pieces fit together for you? And if you're married, for both of you, how do these CPP and OAS changes affect you? Depends on your earnings history, your retirement timing, and your total income, which is why coordination matters so much. If you would like help building a retirement income plan that factors in the 2026 CPP and OAS updates that we just talked about and shows you exactly how to structure your withdrawals, time your benefits, minimize your taxes, and coordinate with your spouse, please book a time with me. The link is in this description below. I'd be happy to help. Also, if you found this video helpful, give it a like and a share with somebody who's navigating through these changes themselves. Thank you for watching. I'll see you in the next one.